Why is this important? Because for every organization, one of the most important planning tools is a break-even model. Now, some of you are thinking, wait, why do I want to break even? If the break even is where the total costs equal my total revenue, that's not what I want. And I would agree with you. We're not attempting to reach a break even in most cases. We're trying to exceed it. But how do you exceed it until you know what it is? The break even model is a tool that we use to calculate our minimum threshold. It tells us how many units we need to produce to cover, to pay for all of our fixed costs, all of the related variable costs. So the very next unit, we know we have to be profitable. And it's really the basis of both production planning, procurement planning, profit planning, and pricing planning. And the reason we refer to pricing planning is sometimes you will look at the break-even model and say, if we were to change our price, either up or down, what would be the impact? Would we sell more units or fewer units? Would our profit go up or down? And sometimes it might surprise you. Sometimes when volume goes down, profits go up, and vice versa. It'll depend on the relationship between the cost, the volume, and the profit, which is why break-even is so frequently referred to as a CVP, or cost volume profit model. Now, break-even is really calculated at 3 different levels. The most common way to look at it is the cash basis. That's our first formula here. Break-even on a cash basis is calculated as our fixed cost divided by price minus variable cost. So how much do we sell a unit for, and what are the variable or direct costs to create that? Well, if you look at the definitions in the bottom half of the slide, price minus variable cost is also called our contribution margin, or CM. It is how much of each sale, after we pay for its related variable cost, contributes to paying for our fixed cost for the period. Once all the fixed costs for that period are paid for, the contribution margin contributes to profit. That's why it's an important concept. So on a cash basis, we say, what are our fixed costs? There's your numerator. What's the difference between our price and our variable cost, also known as our contribution margin? That's our denominator. When we calculate this very simple equation, the result is in units. That'll tell us how many units we need to create, we need to sell, in order to cover all costs for that period of time. Every unit that we produce and sell above that level will give us profit. And the amount of profit will be the number of units beyond the break-even times the contribution margin. In other words, you can take this information, calculate your break-even, and right next to it, create a simple income statement that tells you at any given volume what your profit will be. It's a very simple, very accurate planning tool. So that's your cash break-even. The accounting or the accrual break-even is expanded just beyond this because for most of us, we're not on cash accounting, if we remember. We're on accrual accounting. So we want to change the numerator to go beyond just our fixed cost and add in the non-cash deductions. Remember, we're going to have these expenses from an accounting standpoint, even though we're not going to have to pay for them in cash. So our numerator is expanded. Effectively, it's the same denominator. So an accounting break-even, as you'll see in just a moment, is always going to be a higher number of units than the cash break-even. So cash break-even is the baseline. Accounting or accrual break-even is what most of us are actually going to use as a tool. And if you want to forecast into the future, to not only include a break-even but also a break even that achieves a certain level of OCF. Oh, let me stop. OCF is operating cash flow. Operating cash flow refers to our net income, EBIT, plus our non-cash deductions, minus our tax. Here's your operating cash flow. So the financial or forecasting break-even is the one that many of us use for projecting into the future. If we not only want to hit that break-even, but we want to achieve a certain target operating cash flow, we'll use the financial or forecasting break-even. Cash is the baseline. Accounting or accrual is what is frequently used in organizations unless we want to truly look into the future and hit a specific target rather than just the break-even. So cash break-even, an accounting break-even, or a financial break-even. Those are the three alternatives. So let's take a look at these actually in an Excel model. And we'll be sending you these various Excel models as we go through here and as you go through the modules. Here's a simple example. You've got 500,000 in fixed cost. The variable cost per unit is 50. The selling price is 100. Therefore, you'll calculate 50 as the contribution margin. And let me stop here a second and explain our protocol on the Excel models. Yellow cells are input cells. That's where we can input the values or the information that is needed. The green cells are the output cells. They always have formulas in them. So in any of our models, as you change your inputs, the green cells, the outputs will automatically calculate. So based on the formulas that we just looked at, with 500,000 in fixed cost, 50 in variable cost, 100 as our selling price, the cash break even would be 10,000 units. And if you want to prove that out, merely move to the right, create a little income statement, 10,000 units at selling price of 100. There's your 100,000. Then you'd have 10,000 units times your variable cost. There's your cost of good. That's 50,000. That's 500,000. You have 1,000,000 and 500,000 as your variable cost. 1,000,000 minus 500,000 for variable cost would give you gross profit of 500,000 minus your 500,000 in fixed cost would give you zero profit. It proves the function works. The formula works. So that's on a cash basis. On an accounting basis, remember, the denominator is the same. That's our 50 per unit contribution margin. But the numerator is now our fixed cost plus our non-cash deductions. Fixed cost of 500, non-cash deductions of 250,000. Our numerator is now 750,000 divided by our contribution margin of 50, which is why we end up with 15,000 units. And this should be very logical to you. The numerator on an accounting break-even, going back to the previous slide, is larger than on a cash basis. Therefore, we need even more units to achieve that break-even. The third form, the financial break-even, denominator is the same. Numerator takes our fixed cost of 500 plus our target operating cash flow of 550 divided by our 50 contribution. We'd need 21,000 units. Very simple, very practical tool for taking some basic information, putting it into a model, calculating the targets we need, and then setting up our operations to achieve that. So I hope in this module we've been able to really enlighten you as to the three different pillars of finance, the differences between operating and capital leases, the fundamentals of cost and breaking them down into variable versus fixed versus mixed, and the break-even model at the three different levels, and so you can see the real value of using this as a planning tool. Until next time, this is Daniel Feynman.
Outstanding. Again, Daniel, thank you so much for a great session there with business owners and directors today. If you're listening, you may have had a few phone calls there. That's just the normal aspect of business, and that was my call ringing. Apologize for that. But you've just received some of the most cutting-edge training there is as of today when it comes to information for your finances. Daniel, is there anything else you would like to add, maybe is the next step for them to take while they wait to go over the fifth module, which I'm very, very excited about, which we'll be covering shortly?
Yeah, what I would offer to everyone is, now that we've gone through the first 4 modules, if they have reviewed the information in each of the modules, it's now time to take a look at the Excel models that they should have, that we created for them, and change some of the inputs. Take some of their own personal corporate information, put it into the models, and see what results they get.
Incredible. And again, the Excel form is found right at the bottom of this recording, so you can just click on that. You'll be able to download it and use it. If you encounter any problems, again, you know where to find the support. Do not stay away to reach out to us and the team. Daniel and myself will be in these groups to make sure that you have the the attention that you require. With that said, I look forward to being with you in the next episode, or into the next module that we're going to be covering. Again, an exciting time. If you have got questions, get ready with those questions. And if you've got any contribution, again, send them to the support. We'll also be incorporating those, or we'll be open to reviewing them. With that said, have a great day and implement. You see, nothing happens until you implement, the strategies that you're learning today. Once again, Daniel, thank you for being so generous with your knowledge to us.
Absolutely, Yukai. I look forward to this again.
Incredible. Have a great day, everyone, and I wish you all the very best of today.